How to make passive income with oil and gas royalties. For investors looking to diversify their portfolios beyond stocks and fixed income securities or fund retirement, investing in royalty income can offer long-term profits. Holding royalty rights offers a consistent income that is frequently protected against changes in the equity and bond markets. By acquiring shares of royalty trusts or placing a bid on royalty auction markets, investors can purchase rights to royalties income. If you're considering investing in royalties, you should watch this video through until the very end. A royalty is a sum of money given to the owner of an asset by a third party in exchange for their usage of the asset. In many cases, the asset is intellectual property. For each unit produced using that patent, the manufacturer of the product might pay a royalty to the patent's owner. Royalties from an intellectual property can also take the form of compensation for using patents, trademarks, and copyrighted works like music, movies, or novels. Oil, gas, and mining leases produce royalties for the exploitation of natural resources in addition to intellectual properties. According to the Internal Revenue Service, royalties are considered passive income. This means that it is typically subject to capital gains tax, which is typically a lower rate than the one paid by an individual on earned income like earnings and salary. Gas and oil. Owners of mineral rights may be eligible to collect royalties that represent a portion of the cost of energy resources that are extracted from their land. As long as a copyright, patent, trademark, mine, oil well, or other source is producing income, investors who receive royalty income will continue to receive their payments. As a result, royalties have the potential to be a reliable source of long-term revenue with little danger of loss. When a song is used on the soundtrack of a well-known film or when energy prices significantly climb, royalties can occasionally jump considerably. Purchasing royalty trusts. Buying shares of a royalty trust is the simplest way to invest for royalty income. They are publicly traded corporations that purchase the ownership of leases and mineral, oil, and gas reserves. Dividends are given to stockholders from the royalties income. Royalty trusts are exempt from the double taxation that is imposed on the majority of corporations since they distribute 90% of their profits as dividends. Investors in royalty trust shares, however, pay personal tax rates on the dividends. Mining and drilling are not done by royalty trusts. Another business is in charge of that area of the enterprise. They make it possible for investors to take part in the mining and energy sectors without owning any mines or wells. Many investors focus on commodities that have strong prospective earning possibilities with little risk of decline. For many investors, buying and selling oil and gas royalty rights is a wise and tried and true investing strategy. Both buyers and sellers may find oil and gas royalties to be lucrative investment opportunities. The most crucial thing to keep in mind is that you must have a dependable, reputable, and knowledgeable brokerage whether you are buying or selling oil and gas royalty payments as an investment. Oil and gas royalties are based on the amount of material produced and the price of the oil or natural gas at the time of extraction, much like royalties paid on manufactured goods to their inventors or musicians for their compositions. The level of investment a shareholder has in a specific well should be the first factor taken into account when analyzing oil and gas royalty payments. Landowners may be entitled to 100% of the royalties produced by wells on their property, or they may choose to sell shares in future royalties to generate income. Understanding the sort of investment commodity, the industry it belongs to, the trends for the commodity's use, the longevity of the commodity, and many other challenges and aspects are worth the time. What is a royalty interest in oil or gas? A royalty interest is an oil and natural gas lease that grants the owner of the interest the right to receive a portion of the production from the leased acreage, or of the proceeds of its sale, but typically does not require the owner to pay any portion of the costs of drilling or operating the wells on the leased acreage, according to MineralWise.com's definition of the term. It is crucial to take into account the source of the property or the leaseholder's interest before opting to invest, regardless of whether the royalty owner's interest in the oil and gas lease is only owing to an investment scenario or due to being in the oil and gas drilling sector. Owner of interest or non-owner of interest. Investors in oil and gas royalties might be either interest owners or non-interest owners. An investor who also owns the land, The business engaged in prospecting, drilling, or material extraction is known as an interest owner. An oil drilling and/or producing business might be an interest owner. An investor who does not conduct prospecting, drilling, or material extraction is known as a non-interest owner. The owner of a non-interest royalty is only interested in the well's output. They are not interested in the expenses associated with the search for, access to, or production of subsurface resources. How should an oil or gas royalty payment be calculated? There are numerous approaches to determining the worth of oil royalties or gas leasing royalties. The importance that those estimating the value place on various aspects of the oil or gas leased property, such as its history of production, plans for future expansion of the production field, trends in the value of the commodity over time, and many other considerations, leads to different valuations. To arrive at the most accurate assessment possible, it is imperative to compile as much pertinent information as you can. When estimating the probable future value of an oil or gas royalty, there are 5 key factors to take into account. Within the unit or region of commodity production, acreage is owned by a lessor. The total area of the field used to produce oil and/or gas. The overall output of gas and/or oil from the field holding the lease. Before determining net revenue for royalty interest, production costs are deducted. Percentage of royalties received from a leasing arrangement for oil or gas. For an oil or gas lease, the typical oil royalty payment. Oil and gas businesses have been assessed a royalty by the federal government on hydrocarbon resources taken from public lands. 12.5%, or 1/8 of the royalty, was the usual federal royalty payment. Royalty rates were significantly reduced by the Trump administration by tying them to the price of oil. The rates have gotten as low as 0.5% on some lands. State rates have an impact on royalties on private lands. Typically, they fall between 12 and 25%. It is important to carefully carry out due diligence to confirm ownership before negotiating royalty payments for privately owned land. Records of who owns which minerals are frequently stale. What is the duration of oil and gas leases? Unlike some commodities, which may be produced continuously, oil and gas eventually run out. When production reaches its peak, the expenses of extracting the resource may be more than the profits realized once the field has been fully utilized. An oil or gas field will typically continue to produce for up to 35 years. For investors looking for safe, long-term returns on their money, an investment that can generate income for more than 20 years is a suitable choice given all the ups and downs in the stock market and other commodity-based investments. Before investing in a royalty opportunity, it is crucial to comprehend the terms and circumstances of an oil or gas lease because each royalty arrangement is unique. How can you purchase oil and gas royalties? For some people, purchasing or investing in oil and gas royalties can be difficult, while it may not be as difficult for others. Some investors do their homework before buying royalties, and they don't mind spending the time to research, appraise, and determine profits on their own. There's a ton of documentation relating to output figures and economic problems, and the internet has a ton of information about properties. Yet, many investors find that working with a royalty brokerage with industry experience is easier, faster, and better for them than doing their research and analysis. When making an investment, cash flow, taxes, and other financial concerns must be completely understood. A top-notch investment agency can assist clarify the risks and rewards as well as offer insight into potential expenses and other aspects. Before investing, one needs to perform extensive research into economics, politics, regulations, taxes, and a dozen other topics. The chance to buy an oil or gas royalty can arise at any point in the commodity price cycle with sufficient research and analysis. How was the video? Did you enjoy it? Post your feedback in our comment section below. And subscribe to our YouTube channel for more updates.